In this video, we're going to show you how to use the most important trading tool, which is the footprint chart. If you don't master this tool, you'll never make money trading. There's no way around it. So here's exactly what we'll be covering in this video. Please hit the like button, but more importantly, hit the notifications bell as it goes a long way in supporting our team. Starting with topic number 1, why are footprint charts important to use? Using price action on its own is effective, but it's not enough. Price action allows you to find great trade setups, but footprint charts allow you to see whether those trade setups are of high quality. Or to be more specific, footprint charts allow you to see whether the big guys and large institutions are actually taking action at those trade setups, which is what creates actual big volume and big momentum for your trades and results in larger profits. Footprint charts are one part of the larger concept of order flow. Here's where the magic happens. When you combine price action with order flow and footprint charts, this is when your trading is taken to the next level and is how the pros trade. Without footprint charts and order flow, you are essentially trading blind and you will keep failing. Now, there are many other order flow topics you must learn as well. If you want to learn more about these other topics, we have a free order flow trading guide that works in combination with this video. We'll show you how you can get it later in this video. So let's now get into how to set up the footprint tool on your charts. At the top here, go down to Volume Footprint and select it. You'll then see it applied to the right and left side of every single candlestick. If you want the exact free charting platform we are using, click the link below this video. So next, how to read a footprint chart. This is your traditional candlestick. All data you see to the right and left occurs within that one candlestick. So if you're on the daily time frame, all this data occurs within that one day. If you're on the 4-hour time frame, all this data occurs within that 4 hours you're looking at, and so on and so forth. On the left, each box is the selling volume that occurred at the specific price to the right. On the right, each box is the buying volume that occurred at the specific price to the right. You can already see how this makes a huge difference because you can actually see the buying and selling that is actually occurring behind the scenes at each price level instead of just looking at a candlestick on its own. This makes all the difference when you use multi-time frames because you can find high volume areas from your higher time frames and then use the lower time frames to find specific entries at those higher time frame, high volume areas. We discuss this concept in depth with our members. Shades of green. Now on the buy side, notice how there are different shades of green. The brighter the green is, the higher the buying volume is. The darker the green is, the lower the buying volume is. Shades of red. On the sell side, notice how there are different shades of red. The brighter the red, the higher the selling volume is. The darker the red, the lower the selling volume is. Point of control. This area in white is known as the point of control and is where the most trading volume occurred, meaning the area was of the highest interest to buyers and sellers. This is important because if there was heavy interest at this area in the past, there may be heavy interest again once price comes back to this area on the lower intraday timeframes, meaning point of controls can be used as entry points and exit points for future trade setups. Value area. VAH stands for value area high and creates a dotted line across. VAL stands for value area low and creates a dotted line across. This area in between is known as the value area, which is where 70% of all volume was traded for that candlestick. Value areas are key for finding trade entry and exit points within a wider area. Total buying volume. At the bottom of the buy side, this number is the total buying volume, meaning if you add up each row on the buy side, it will give you this number here. Total selling volume. At the bottom of the sell side, this number is the total selling volume, meaning if you add up each row on the sell side, it will give you this number here. total volume overall. This number here is the total volume overall for that entire candlestick. Meaning, if you add up all the buying and selling volume, you get this number. Using total volume is good when you want to compare the volume of one candlestick against another for trade opportunities. Delta. This here is your delta. Delta is the difference in volume between all buying volume versus all selling volume. So when you see the delta number in green, it means there was overall more buying volume than selling volume, and the number is by how much. This can be seen as a bullish indicator. When you see the delta number in red, it means there was overall more selling volume than buying volume, and the number is by how much. This can be seen as a bearish indicator. Changing to a delta chart. Instead of having both the buy volume and sell volume on each side, you can change your footprint chart settings to just show the delta for each row. Right-click on your charts and click Settings. Beside Type, click the drop-down menu and click Delta. Now on your charts, it just shows one row with the delta number for that row and price. So when you see green, that means there was overall more buying than selling that occurred at that price level, and the number is by how much. When you see red, that means there was overall more selling than buying at that price level, and the number is by how much. Using delta this way allows you to see whether each price level is bullish or bearish, which you can then apply to the lower intraday timeframes for trade entry and exit points. Let's now get into the strategies section, starting with strategy number 1, which is the delta change strategy. So before we continue, we want to hear from you. What other topics do you want us to cover next? Do you want more order flow and advanced trading topics? Do you want news topics? Do you want price action topics? Let us know in the comments below right now specifically what video topics you want us to cover next. Also, please hit the like button as it goes a long way in supporting our team. Step 1. Identify a key level. These two reversal points give you a key support level. This level is key because 2 times in the past, when price came down to this level, it failed to break through and bounced upwards. This means if this level was of interest to buyers and sellers in the past, then it can be of interest to buyers and sellers in the future if price comes back, which means long trade opportunities arise at this level. Step 2. If price comes back to the level, look for price action at the level. Price comes back to the key level, and you have 2 candles forming right at the key support level, and that failed to break through the support level and failed to form a lower low, which is price action that tells you that buyers and sellers are taking action at the level and holding the level strong. This then also means you have a triple bottom pattern, which is a reversal pattern because short sellers tried 3 times to push price lower but failed. Step 3. Look for a change in delta after consecutive opposing delta. So when we zoom in, notice how when price came down to the key level, you had all red delta, meaning 4 consecutive candles in a row where there was overall more selling volume than buying volume, meaning sellers were in full control of the downtrend and bearish momentum. You then finally had green delta appear after 4 red delta prints, meaning you finally have more buying volume than selling volume, which shows that short sellers are losing steam and closing their short positions, and that buyers are stepping in and are now taking control, which signals a loss of bearish momentum and the start of bullish momentum. Step 4. Look for a trend change confirmation after your delta change. After you had this candle here with the delta change to green positive delta, we need to look for any form of trend change confirmation price action. So when we zoom out, you can place a trend line like this. And once it broke here with the higher high, this confirms the trend change and is the start of the next leg up. This is also a descending triangle pattern, which is a trend continuation pattern when broken above. Step 5. Intraday entry point. After the trendline break and higher high, you go to the lower intraday timeframes to find an exact long entry point using our key order flow entry strategy and tool. If you zoom out even further, you can see how massive this move ended up being. This is the power of combining price action with order flow. Now, going in the opposite direction. Step 1. Identify a key level. Price comes up before reversing drastically, giving you a key resistance level. This level is key because if buyers and sellers took action at this level in the past, when price comes back to this level in the future, there might be interest again, meaning short trade opportunities arise at this level. Step 2. If price comes back to the level, look for price action at the level. Price comes back to the level, and you have a very long wick candle that forms right at the key resistance level and failed to form a higher high bullish engulfing candle. The candle with the very long wick sticking out the top is price action that tells you that buyers are taking profit and that sellers are opening new short positions. Step 3. Look for a change in delta after consecutive opposing delta. So when we zoom in, notice how when price came up to the key level, you had all green delta, meaning 4 consecutive candles in a row where there was overall more buying volume than selling volume, meaning buyers were in full control of the uptrend and bullish momentum. You then finally had red delta appear after 4 green delta prints, meaning you finally have more selling volume than buying volume, which shows that long buyers are losing steam and closing their long positions, and that sellers are stepping in and are now taking control, which signals a loss of bullish momentum and the start of bearish momentum. Step 4. Look for a trend change confirmation after your delta change. You can enter on the bearish engulfing confirmation candle, but for an earlier entry point, you need to look inside of the long wick delta change candle on a lower intraday time frame for price action that signals a trend change from an uptrend to a downtrend, and then enter using our key order flow entry strategy and tool. Moving on to strategy number 2, which is the stacked imbalance trading strategy. Imbalances are one of the most important parts of footprint charts. So first, what are imbalances exactly? Imbalances are areas on your chart where there was a large gap or large discrepancy between buyers and sellers. When you right-click on your chart and go to settings, you can see that the imbalance here is set to a default of 300%, meaning imbalances on your footprint chart will only appear when there is a gap or discrepancy of 300% or more. Now, on your charts, imbalances are shown through these highlighted areas to the right and left. Again, they only appear when there is an imbalance or volume gap of 300% or more. On the right side, when you see the imbalance in green, it shows a big buying imbalance, meaning that price area experienced 300% or more buying volume than selling volume, thus creating an imbalance because there was significantly more buying interest than selling interest in that area. Imbalances are diagonally calculated from bottom left and upwards to the right. So when you see a buy side imbalance, you're looking at this number here against the highlighted number here, and the volume gap between the two numbers is 300% or more. On the left side, when you see the imbalance in red, it shows a big selling imbalance, meaning that price area experienced 300% or more selling volume than buying volume, thus creating an imbalance because there was significantly more selling interest than buying interest in that area. Again, imbalances are diagonally calculated from bottom left and upwards to the right. So when you see a sell side imbalance, you're looking at this number here against the highlighted number here, and the volume gap between the two numbers is 300% or more. So what are stacked imbalances then? Just like the name says, stacked imbalances are when you have multiple imbalances stacked on top of each other, thus creating a zone that presents trade entry and exit opportunities. To set up stacked imbalances, right-click on your charts and go to Settings. In the Imbalances section, click where it says Stacked Levels. The default is set to 3, which means the stacked imbalances will only appear on your charts when there are 3 imbalances on top of each other. We use a tweaked version of these settings, but to keep it simple for this video, leave everything else as the default. Now back on your charts. When you see the green highlighted rows that stretch across your charts, these are buy-side stacked imbalances, meaning 3 imbalances stacked on top of each other. Buy-side stacked imbalances can act as a form of support, meaning long trade opportunities arise at these areas. And also, these areas can act as places to close your short positions. When you see the red highlighted rows that stretch across your charts, these are sell-side stacked imbalances, meaning 3 imbalances stacked on top of each other. Sell-side stacked imbalances can act as a form of resistance, meaning short trade opportunities arise at these areas. But also, you can use these areas to close your long positions. So, let's show how to use stacked imbalances on their own for trade entries. Here is your buy-side stacked imbalance. Price came down, formed a long wick candle, followed by a bullish green candle, which presented a long trade opportunity, as the buy-side stacked imbalance acted as a form of support. Here is your second buy-side stacked imbalance. Price came down and formed a bearish engulfing candle that broke right through the stacked imbalance, so there was no long trade opportunity. Here is your third buy-side stacked imbalance. Price came down and formed a candle with the wick sticking out, followed by a green inside bar, which shows a reaction to the stacked imbalance and presented a long trade opportunity. Price comes down, forms a very long wick candle at the stacked imbalance, presenting another long trade opportunity. Going in the opposite direction. Here is your sell side stacked imbalance. Price came up and formed a very long wick candle, which presented a short trade setup because the sell side stacked imbalance acts as a form of resistance before price reversed downwards. As always, we like to combine trading tools with other price action methods in order to enter higher quality trades. So let's now combine stacked imbalances with key levels. For the strategy, go to your settings and change it from 3 stacked imbalance levels to 2 stacked imbalance levels, because since we're combining imbalances with traditional key support and resistance levels, we loosen up the requirements in order to find more trade setups, as 2 stacked imbalance levels is still very high quality. Now on your charts, these 3 reversal points give you a key level. Here's your entry number 1, through the very long wick candle at the key support level, at where the trend line crosses, and also where the stacked buy-side imbalance lines up perfectly at the same area, which presented a high-quality confluence stacking long trade setup. You would then go to the lower intraday timeframes and enter using our order flow entry strategy. These 4 reversal points then create another key support level. Here's your entry number 2, through the very long wick candle at the key support level, at where the trend line crosses, and also where the stacked buy-side imbalance lines up perfectly at the same area, which presented another high-quality confluence stacking long trade setup. You would then go to the lower intraday timeframes and enter using our order flow entry strategy. These 5 reversal points create another key level. Here's your entry number 3, through the 2 candles with the wicks sticking out at the key support level, at where the trend line crosses, and also where the stacked buy-side imbalance lines up perfectly at the same area, which presented another high-quality confluence stacking long trade setup. You would then go to the lower intraday timeframes and enter using our order flow entry strategy. Notice how each trade became more and more profitable, because the more you stack confluence factors, the higher the trade quality increases, which results in larger trades. Let's show this again. This swing low, huge reversal point gives you a very key support level. Your stacked buy-side imbalance also lined up in the same area. When price came back down, you had a long wick candle form right at the support level and at where the buy-side imbalance lines up as well, which presented a high-quality confluence stacking long trade setup. The next candle failed to break through and also had the wick sticking out the top side, which shows another reaction to the area. You would then go to the lower intraday timeframes and enter using our order flow entry strategy. Now at the top, these 2 reversal points give you a key resistance level, and also the sell side stacked imbalance lines up as well. Now when price got to the area, you had no candlestick pattern form, and instead, price gapped through the level, meaning you had no reason to close your long position, but also no reason to open a new short position. This also shows how important the concept of knowing where price is coming from is, because long traders loaded up on long trades at your trigger event area here. So the momentum was so strong, and they weren't looking to close their positions out so fast. Price then continues on upwards. And here's your next stacked sell-side imbalance zone. Notice how many imbalances are stacked up at this area, making it a resistance wall. But now, the most important part is that this massive, very long wick candle forms right at the stacked sell-side imbalance zone, which shows buyers taking profit and sellers opening new short positions, which may result in a reversal. You also have this gap up here, which may result in a gap fill back down. Regardless, all of this signals that this is a great exit point for your long trade you took earlier. And this was clear through the reversal of price that eventually occurred. Now going in the opposite direction. This swing high reversal point gives you a very key resistance level due to how drastically price reversed after it got there. Your stacked sell-side imbalance also lined up in the same area. When price came back up, you had a candle with the wick sticking out right at the resistance level and where the sell-side imbalance lines up as well, which presented a high-quality, confluent stacking short trade setup. The following candle also failed to push higher and instead formed a bearish engulfing candle, which again confirms the area is holding strong. You would then go to the lower intraday timeframes and enter using our order flow entry strategy. Now, the techniques and strategies we've covered in this video are very basic and only scratching the surface. You need to learn all these advanced order flow methods and strategies, and so much more that we cover with our members. Without learning all of these, you're trading blind. So to access our free order flow trading guide, click the link below this video, or go to wisetrade.com. As always, please hit the like button, as it goes a long way in supporting our team. So thanks for watching, and I'll see you in the next episode.